Hey everyone, and welcome to the Deep Dive. Today we're going back in time, way back to 1957,
Oh, wow.
to explore an early letter Warren Buffett wrote to his investment partners.
Sounds fascinating.
It's like a window into his mind,
Oh,
before
yeah.
Berkshire Hathaway.
Before the legend?
Exactly before he was a household name.
So this is like pure Buffett,
Exactly, raw and unfiltered, just his early investment philosophy.
a glimpse into the origins of his thinking.
I'm already intrigued. So 1957, that was a pretty turbulent year for the market, right?
It was a roller coaster, to say the least.
What jumps out at you from Buffett's perspective on all of that?
Well, what's interesting is that while everyone else was kind of panicking about the market decline,
Right.
Buffett seemed totally unfazed. He even said that the drop wasn't as bad as people thought.
That's interesting. Almost like he was seeing opportunity where others saw disaster.
Exactly. He was already thinking differently even back then.
A contrarian even in the 50s?
Precisely. He even pointed out that stock prices hadn't fallen as much as corporate earnings. So he was basically saying the market was still overvalued.
Even after the decline.
Yeah.
Yeah, he was already looking beyond the surface.
So even then, he was thinking independently, forming his own conclusions.
It seems like he wasn't swayed by the market's short-term mood swings.
More focused on the fundamentals.
Exactly. He was playing the long game.
Makes you wonder what made him so different from everyone else.
Right. Was it better information? Higher risk tolerance? Or something else entirely?
Well, the letter gives us a few clues. He talks a lot about focusing on a company's intrinsic value.
That underlying worth of the business.
Right. It seems he was less interested in the market hype and more interested in the true value.
The long-term potential?
Okay, so he was looking deeper than the average investor. And the letter also outlines his two main investment approaches at the time, right?
Yes, undervalued situations and workouts.
Two sides of the Buffett coin.
I like that.
So undervalued situations, I mean, it's pretty straightforward, right?
Yeah, it's about finding solid companies with strong long-term potential that the market is just underpricing.
The hidden gems and workouts, those sound a bit more complicated.
They can be a workout hinges on a specific corporate action, like a merger or a liquidation.
Okay.
The profit potential comes from anticipating those events and understanding how they'll impact a company's value.
So it's less about general market trends and more about specific situations.
Precisely.
Can you give us an example from the letter of how a workout might play out?
Sure. Buffett mentions a company called Sanborn Map Company that was undergoing a reorganization.
Okay.
He saw an opportunity to buy stock at a discount because the market hadn't fully grasped the potential value that would be unlocked through this restructuring.
So it's about understanding those behind-the-scenes moves and how they impact a company's stock price.
Exactly.
Yeah.
Even if the market is slow to catch on.
It sounds like both undervalued situations and workouts involve a lot of research
A lot of research.
and a willingness to be patient.
Absolutely. And that's a theme that runs throughout Buffett's career, taking a long-term perspective and not being swayed by short-term market fluctuations.
So let's talk results. How did these strategies actually perform in 1957?
Well, the Dow Jones Industrial Average was down over 8% for the year, but one of Buffett's partnerships was up 25%.
Wow, 25%. That's impressive. But wasn't that kind of a crazy year? I mean, could anyone really expect to consistently outperform by that much? Even Buffett?
He addressed that directly. In the letter, Buffett talks about the role of luck, especially in the timing of investments. He admits that some of his success in 57 was due to factors outside his control.
So he's acknowledging that even with great research and analysis, a little bit of luck can play a role.
It wasn't all genius. You know what I mean?
Right, a bit of humility there. But even with the luck factor, he clearly had a strategy, a plan for the long haul.
Oh, absolutely. He was building a sustainable approach.
Wasn't there something in the letter about his goal to beat the market by 10% per year over time?
You're right. He wasn't chasing quick wins. He was focused on compounding returns over the long term. That's where he believed the real magic happened.
That's a great point. It's about the steady, consistent growth, not the one-off lucky streaks.
Right. And that leads us to another key element of his 1957 letter, the idea of patience as a superpower. Let's dig into that a little deeper in the next part of our deep dive. Welcome back to our deep dive into Warren Buffett's 1957 investment strategy.
That 25% gain in one of his partnerships is still on my mind. Makes you wonder what stocks he was picking back then.
Well, we don't know the exact portfolio from back then, but remember, it's more about understanding his approach, not just replicating the trades.
Right, the principles are what matter. And one thing that stood out to me was how clearly Buffett laid out his views on the market.
Yeah, he didn't hold back, did he?
Not at all. He straight up said he believed the market was still overvalued even after that decline.
Even after everyone was freaking out about it. Yeah, he was
Yeah.
going against the grain.
Forming his own conclusions independent of the crowd.
That independent thinking, that willingness to disagree, that's a sign of a great investor.
It makes you wonder how he developed those convictions so early in his career. Was it all research, or was there some intuition involved too?
That's a great question. The letter doesn't say specifically how he made decisions, but we can see some clues.
Okay.
He talks about thoroughly understanding a business before investing, digging into financials, analyzing the competition, really getting a deep understanding.
So it sounds like his convictions were based on solid research and analysis.
Not just a hunch. Yeah, he did his homework.
So it wasn't just about being contrarian for the sake of it. It was about trusting your own judgment.
Exactly. Even when it differed from the crowd.
Now let's get back to those two investment approaches, undervalued situations and workouts. I'm still a little fuzzy on how those workouts actually work.
Okay, so remember, a workout involves taking advantage of specific corporate events, like mergers, liquidations, spin-offs.
Right.
The key is to anticipate how those events will impact a company's value.
And often before the market figures it out.
Exactly. It's like thinking a few steps ahead.
Like a chess player.
Yeah, you got it. It's about understanding how each move changes the game.
You mentioned Sanborn Map Company as an example earlier. Could you walk us through that one?
Sure, Sanborn Map Company was known for its fire insurance maps. But as technology changed, the demand for those maps declined.
Right.
However, Sanborn also owned a valuable real estate portfolio.
Ah, so there was hidden value there.
Exactly. And the market wasn't really paying attention to that real estate.
They were focused on the struggling map business.
Right. Buffett saw an opportunity to buy shares at a discount because the market hadn't caught on yet.
So that's where the deep research comes in, uncovering those hidden assets.
Exactly. You got to look beyond the headlines and dig into the details.
It sounds like workouts require a pretty specialized skill set.
It definitely helps to understand financials, corporate law, and specific industries.
Okay.
But the principles can be applied by anyone who's willing to put in the work.
So you're saying it's about developing your analytical skills.
Exactly. And learning to spot value where others don't.
Now let's talk about undervalued situations. They seem simpler, but I imagine there's still a lot of nuance in identifying them.
Oh, absolutely. It's not just about finding companies with low stock prices. It's about understanding their intrinsic value.
What the business is really worth.
Right. And for Buffett, that's based on the present value of a company's future cash flows.
So it's not just about looking at the current numbers, it's about projecting into the future.
Exactly. And understanding what will drive those future cash flows.
Did Buffett mention any specific undervalued situations in his letter?
He didn't name any companies probably to protect his clients.
Right, of course.
But he does give some general examples,
Mhm.
like companies with low debt and strong management teams.
Those sound like good starting points.
He also talks about the importance of a moat, a
Right.
durable competitive advantage.
Ah, so companies that can withstand competition over time.
Exactly. These are timeless principles that apply in any market.
So it's not about the specific companies he liked back then. It's about the way he thought about finding undervalued opportunities.
Right. The thought process, the framework for analysis.
It seems like both undervalued situations and workouts share that focus on finding hidden value.
Definitely. They both require patience, discipline, and a contrarian mindset.
It's about doing your own research and having the courage to act on your own conclusions.
Even when everyone else disagrees.
We've covered a lot in this part. From contrarian thinking to workouts to finding hidden value. What other takeaways from Buffett's letter should we touch on?
Well, remember that impressive 25% gain. We talked about luck, but there's another element that's crucial to his success: patience. Let's explore that more in the final part of our deep dive.
Welcome back to the deep dive. We've been exploring Warren Buffett's 1957 letter and uncovering some really interesting stuff.
Some timeless wisdom.
Exactly.
Yes.
And last time you mentioned the importance of patience in his approach.
Oh yeah, that's huge for him.
So how did that play out in 1957? Was it already a core part of his strategy?
Absolutely. It was front and center even back then.
Okay, I'm curious to see how, remember that 25% gain in one partnership?
Oh yeah.
What role did patience play in that?
Well, in the letter, he talks about building a position in a company over time, instead of jumping all in at once.
So like a gradual process.
He called it letting his investments marinate.
Marinate, I love that. So instead of rushing in, he was taking his time?
He wasn't chasing quick wins.
More like letting things develop?
He was waiting for the right moment for the market to catch up to his assessment of a company's value.
That's so different from how a lot of people invest today.
Yeah.
With all the information and trading apps, it's easy to get caught up in the frenzy.
It is. It's like everyone's trying to time the market perfectly.
But Buffett's approach was much more deliberate.
He was playing the long game.
But wasn't he also involved in those workouts, which seem like they require quick action?
Right. Good point. It's not that patience means doing nothing. It's about being disciplined, waiting for the right opportunity, and then acting decisively.
So knowing when to wait and when to strike.
Exactly. And even within those workouts, patience is key.
How?
Well, he mentions a case where he held a big position in a company that was going through a legal battle.
Oh, wow. So there was a lot of uncertainty.
Definitely. He believed in the long-term value, but he had to ride out the storm.
So he trusted his research even when things got tough?
Exactly. That's where true patience shines when everyone else is panicking.
It's about having the conviction to stick to your guns.
And remember, this was years before Buffett became a household name. Patience was already a core part of his process.
It makes you wonder how he developed that patience. Was it something he learned, or was he just born with it?
Probably a bit of both, but the letter gives us a clue. He talks about thoroughly researching companies, understanding their business inside and out.
So that knowledge gave him the confidence to be patient.
Yeah, he knew what he owned and he believed in it.
We've covered a lot today, from contrarian thinking to workouts to patience. What would you say is the biggest takeaway for our listeners?
It's tempting to focus on the specific stocks, but I think the real lesson is the mindset. The 1957 letter shows us a young Warren Buffett who thinks differently.
Right.
He's focused on the long term. He's willing to go against the crowd, and he understands the power of patience.
Those are qualities any investor can develop.
Absolutely.
Yeah.
And that's what makes this deep dive so valuable. It's not just about Warren Buffett. It's about how we can all become better investors.
By learning from the best.
Exactly.
Well, thank you for joining us for this deep dive into Warren Buffett's 1957 investment strategy. It's been an incredible journey.
It has. And we hope you've gained some insights that will help you on your own investing journey.
Remember, the best investment you can make is in your own knowledge.
Couldn't agree more.